Well, good afternoon, everybody. It is Close of Business Tuesday. It is December 21st. We are really excited because we got a fantastic guest and we got kind of a fantastic theme. Let me talk about our guest. Carolyn Hansard is from Texas Teachers. You've heard of them. You know they're very large. Carolyn is super important there. She's the senior director and the portfolio head and chair of the investment committee for the energy, natural resources, and infrastructure portfolio. There is $19 billion or so under management. Prior to being at Texas Teachers, she was for 17 years at Merrill Lynch in New York, London, and Tokyo. She is a graduate of the great University of Texas, both undergrad and MBA. She spent a long time with Arthur Andersen. Carolyn, I should say one of our favorite parts of your bio is you're a good friend at TPH, and we love you to death, and we're so glad to have you.
I am really happy to be here. And as I said, we've known you guys, or I've known you guys over a decade, and you've been a really good partner to us. So thank you for having me.
Well, we'll try not to mess that up with today's show. No, seriously, we're really so glad to have you. And we think you're a fantastic guest to help us close out the year. This will be our last one of the year. So the team with me today, Mike Bradley, Matt Portillo, Colin Fenton, and Chad Michael, the new president of TPH, we'll all replay the year a little bit before we talk to Carolyn about some of the big things going on in energy. Mike Bradley, why don't you kick us off? Looking back, looking forward, what do you think? And we should say you are in my hometown where I grew up, Nashville, Tennessee. I'm pretty sure that's the original Hyatt Regency. They call it something else now. But, great background up and down for us to have for this discussion, Mike.
Yeah, Maynard. I mean, I think hopefully we'll see an elevator or two go up, and it will explain all, what energy was about this year, because energy, give or take, was the best performing sector this year. And it wasn't by a couple percent. It was by a huge amount. I mean, we're talking about 45%. It was up year to date. The next closest sector was real estate, up 37%, and financials up 30%. To put that in perspective, the S&P was up around 22%. One of the things that we fought all year long, and it's really kind of played out interestingly this year, is that, with us being up 45% traditional energy, clean energy, the ICLN ETF was down around 25% this year. So almost 70% outperformance versus clean energy. So this definitely was a year where traditional energy performed well. Some of the themes, you wanted to talk about themes this year. Obviously, energy outperformance was a big theme this year. I think the group was underweight. I still think the group is underweight at less than 3% weighting. I think it could double from here in the next couple of years. I think the other thing that was very, very much resonating was return of capital. I think at the beginning of the year, late last year, beginning of this year, people did not believe E&Ps were going to be capital discipline. And they didn't believe they were going to return cash, and they did it in spades. And they continue to do it in spades, so much that the energy secretary said, why are people not picking up rigs and drilling? And so I think those were some dominant themes this year. The other themes I thought that were interesting was OPEC Plus seized control of the market, and I think that was very, very relevant this year. Also, people forget Biden administration at the beginning of their term had these, they basically shut down Shell pipeline. And had some, federal, permit leasing issues, and that kind of put a little bit of a shadow over the market. Gasoline prices spiked. The president basically released the SPR this year. We saw that. We saw European natty prices jump to all-time high. Generation prices are at all-time highs, and we haven't even seen winter hit yet. And if you look at it right now, we have the equivalent of $60 per MCF natural gas in Europe, and the equivalent of $360 oil in Europe at this point, and winter hasn't even hit this year. The other thing I'd say is U.S. inflation is at 40-year highs. That's a big dominant theme, and that's really kind of playing into energy. But, one of the other themes that I think was prevalent about a month and a half, 2 months ago was this COP26 conference. A lot of high expectations that we were going to get a carbon market structure or have a phasing out of coal. That did not happen. And finally, I think the thing that one of the things that Colin's really been talking about for the last 2 years is nuclear. And I think what's interesting is nuclear has become relevant again, relevant enough that you're hearing some European countries saying that, you know what, we need to change what green really means, transition fuels really mean, and extend that to natural gas and potential nuclear. Those are big, big developments. And so, it's been a really, really good year. Energy, I think, has the backdrop of being able to outperform again next year, as long as guys stay return on capital discipline. It's been a great year. We should celebrate it. I think next year is just going to be just as good, and we're looking forward to it.
All right, Mike, that's a great rundown. Matt Portillo, a lot of things happening, certainly in TPH research this year, but of course in the broader markets. And as we said last week at the town hall, you're a true blue car guy now. You're going to all these car shows and saw the new Humvee, electric Humvee, all these things. What's on your mind as you think back on the year?
Yeah, Maynard, a couple quick things. One, I think what Mike hit was really the key theme for investors, whether you're talking about upstream, midstream, chems, across the sector. 2020 was obviously a really tough year for the industry, but I think a lot of the C-suite and management teams across the board did what they needed to do to get the businesses in shape for the next decade. And in some cases, as it relates to midstream, it was cutting dividends and focusing on the balance sheet repair that's going to occur over the next few years that has set those companies up for success. In upstream, it's been about debt reduction and buying back stock and initiating dividends while also pushing capital discipline that I think has been paramount. Service, we haven't really seen as much participation in the margin uplift as of yet. But over the last 2 quarters, we're really starting to hear a bit more about pricing power. I think that's going to start to be a tailwind for the service sector as we head into 2022. And then we are seeing some interesting themes that are kind of correlated within these subsectors. The auto space in particular went through a really tough year as it relates to the semi shortage. We've now seen a massive drawdown in inventories from an auto perspective over the last year. That's going to set up really well for margins in 22 and 23, but that's also going to be a positive tailwind for the chem sector that has a lot of auto exposure. And as that production starts to ramp, chems companies with that leverage are going to benefit as well. So these themes are really starting to play out in a big way. From a coverage standpoint, we added about 22 names under coverage in the research sector, about $1.5 trillion in market cap, and expect that to double to triple over the next 12 to 18 months. So we're going full steam ahead. Lastly, just on this week's announcement from a client conversation perspective, it was really about the change in the policy support around Build Back Better, which obviously may be dead on arrival here. There's a lot of questions around whether that can be potentially piecemealed heading into 2022 under various different components of legislation. But as we kind of think about it, it definitely has an impact to the energy transition complex in the EV space. The lack of the $12,500 tax credit potentially may impact demand for EVs in the U.S. Heading forward. Most negatively impacting GM and Tesla because they've already gone through their 200,000 units of the existing credit. Things like the ITC extension is something that will impact kind of our solar forecast moving forward. And then even things like 45Q, there is potentially going to be a pretty significant uplift to 45Q as well as a potential credit for direct air capture. So there's a lot in the bill that needs to be unpacked and things that may change here, something to keep an eye on for 2022. But it is really going to be a key driver, especially for these industries that need a lot of policy support as they're kind of in their nascency coming off the ground. And it's something that the team will continue to monitor and work towards kind of publishing research on as we head into next year.
You know, it's funny, Matt, when you say all that, I know Washington doesn't work this way, but they could have divided that into 50 different bills, gotten 45 yeses, and then it looks like Congress is just killing it. Every week they're passing a new thing, but I don't think they think that way, I guess, is my quick judgment there. All right, Chad, let's jump to you. We had a big year at TPH. You and I, 14 years and a handful of days working together. It's been a great partnership. You're now the president of TPH. TPH had a great year. When you look back on the year, what are the things that jump out at you in the deal business or just the moods in boardrooms, just some of your reflections?
Sure. Thanks, Maynard. And I like to say we're now into our 15th year actually together. So it's really been a fantastic run. When we look back at kind of the transaction space and the strategic space over the course of the last year, it's really building upon what Matt and Mike had commented on. And the first place you start is with just the cash flow of the industry. And our world, our coverage world that Matt covers on the upstream side, just for the U.S. independents between oil and gas names, is approaching $75 billion of free cash flow as we get into next year. This year was the beginning of a significant amount of that cash flow build. So just the amount of cash flow in the system is just really remarkable. And that does not include the international or the Canadian names. So just cash, the world of cash flow has really dominated a lot of the focus. But that's actually provided opportunities for the private sector. The private sector has really taken advantage of the uplift in commodity prices and has increased its capital spending at a rate that's outpaced the public names, such that you are in a position now where where private drillers, private companies drilling, are commanding a higher percentage of the market share than we've ever observed. So you've had public companies focus on cash flow. You've had private companies stepping in and providing a bit of incremental production growth. What does that mean on the strategic side? It's really been a very healthy strategic backdrop because you've had a good background for a traditional consolidating transaction, corporate to corporate. You've had transactions where a private has sold to a public, and you've even been able to pull off the rare but sometimes quite valuable private to private merger. So really any sort of transaction that was contemplated in this market, you've really been able to find a way to have success. And that really, I think, sets the stage for next year, which we really see a continuation of really all the flavors of traditional M&A as we get into next year. So that's kind of the base business. And then, of course, new energy is touching everything that we do. Our traditional clients are quite focused on improving their performance as it relates to their operations and making specific commitments that we think are quite responsible. And we think on the new energy side itself, there's going to be a lot of really exciting capital formation and a lot of exciting advances in technologies that we think set the stage for another round of transactions on the new energy side as well. So overall, just a very healthy backdrop as it relates to the transaction world.
Yeah, that is a great rundown, Chad. One just gut reaction when you think of this year's A&D market, which seemed really strong. Thinking back over all our years together, how would you rank the competitive tension, the strength of demand, the volume? What's just your feel about how it compares to previous years?
It had felt really healthy because most of what we were participating in on the sell side, it would seem like there would be real competition down the stretch with maybe two or more buyers competing down the stretch to end up winning the transaction, so to speak. So that generally felt healthy. As we went back and looked at it through the third quarter of this year, we felt like that about 3 out of every 4 transactions that had been brought to market by us or the broader market they were getting done, and that's just a high hit rate, so to speak. So it was a very healthy market where you could really just simply get stuff done, so to speak. I think what the year was characterized by in terms of how the dynamics felt is over the course of beginning in January and over the course of the year, you had in general an escalating and increasing commodity price backdrop. And so what that allowed the market to take advantage of was a world where sellers were getting to sell at a higher commodity price deck than they might have a quarter ago. And you had buyers being able to feel like there was momentum in the commodities market. So really for the first 3 quarters of the year, we had that dynamic. And so that just created a really healthy mindset, both on the buy side and sell side. I will say the more recent pause on the commodity prices that has probably slowed things down a touch. But we actually think, given where prices are right now, there's still a good equilibrium for the bid and the ask to be acceptable to both sides. So we actually are quite excited for what next year could look like as well.
Awesome. Thanks, Chad. That's a great rundown. Colin, we're turning for home. We're going to go talk to Carolyn What would you add as you think back on last year, or just anything that's a front of mind here as we close out the year?
Yeah, thanks, Maynard. As I reflect back on the past year, to me, it really looks like 2021 was the year of truth tellers in debate with dogmatists, and the results firmly validated the truth tellers. But let's be clear on definitions, because those can be pretty charged terms. Dogmatists are not liars. They see the world as they see it, and truth tellers are not always correct, either in matters of fact or opinion, but they have different perspectives in how they approach risk. By definition, dogmatists have a fixed view on defining the perception of the world as they think it is today, and in promoting, without any acceptance of dissent, where they think it's going to go. They have a singular vision for what they want the future to be. Now, I think all of us who are parents can see this in our children sometimes, and can see where disappointment can quickly arise if that's your mindset. Truth tellers attempt to describe the world as it really is, whether they like it or not, to project the world as it's going to be, whether they like it or not. The job is to be accurate as much as you can be. And then also to try to build a better world, but at least to have some acceptance and some forgiveness of where the world really is and what might actually happen. So let me quickly just run through a couple of things that happened this year to illustrate why that might be a good way to think about what happened in 21 and what might happen in 22. So coming into the first part of the year, the big macro question was whether the fiscal and monetary policies, as extraordinary as they were, would yield inflation. And there was a binary answer, yes or no. The truth teller said yes. The dogmatist said no. When the inflation arrived, the question shifted to durable versus transitory. The truth teller said it would be durable. The dogmatist said it would be transitory. By ignoring the fact that it did prove to be durable, inflation was then mooted to be whether it would get back to a 4-year high or not. And the answer at that point from the truth tellers was, yeah, it might get there. It has a good chance. And you had the folks who had said there would be no inflation, it would prove transitory, would quickly get back down to a lower number. When the 40-year high inflation did in fact come, and there is now absolutely no doubt about that, it's broad, it's systemic, we see it everywhere, it's in every category. The view on the table was whether that would produce a backlash against the fiscal and monetary policies that helped to propel it. And the truth teller said, yeah, you probably do get a political pushback on the central banks, and of course, the fixed mindset, the dogmatists said no. Now, obviously, we have seen a backlash. We've seen the United States issue its plea to OPEC. We saw the letter to the FTC alleging that gasoline was somehow being manipulated in its price. We saw the SPR tapped, not for an emergency reason, but to move price. And we saw a United States senator write letters to a dozen or so CEOs asking them to provide more gas domestically. So you saw each of these things happen, and that's just where we've gotten to. Now, getting to our world, the energy world, there were some analogs as well. Coming into 2021, there was the strong assertion that global oil demand had peaked. That was not put out as a forecast. It was stated as fact. The truth teller said, no, it doesn't sound right. The dogmatist said yes. When it was proven that that was not correct, there was an argument that new investment might be necessary. The dogmatist said, no new investment is necessary, famously said the IEA's May 2021 report. Today, as many of you may know, Rystad, the very eminent consulting firm in Norway, reports that at least by its tally, we have a 1946 low, the lowest number since 1946 in new reserves discovered in this calendar year. In 2021, coming into the year, there was a question of whether the cancellation of the Keystone XL pipeline, strains on lease sales, movement on federal lands would or would not have an effect on price. Folks in markets, the truth tellers said, yes, that will affect both present and future prices. The dogmatists said no. Clearly, it did have an effect on price. We saw the cancellation of the Keystone XL pipeline, the argument over Line 5, and others create questions about pipes. The truth tellers said, again, this is going to be a problem. Dogmatists said no. And where we're at today is we're basically using rail cars to bring Canadian crude in ever greater volumes into the United States. We saw this idea that renewables, had fallen in their cost to such a level that they would stay there permanently. And you saw the truth tellers say, well, I actually think it's important to note that copper, natural gas, polysilicon, and other prices go into those cost structures. So be prepared for those costs to rise. Recall we had Mackenzie Davis of Sailing Stone Partners on a year and a half ago making that argument. It's crystal clear he was correct. He was a truth teller. The dogmatist said you should expect static costs, which clearly was not right. Modern monetary theory told us that we could run up huge deficits forever, have spending of trillions and trillions of dollars without consequences, either in inflation or otherwise. This week, Senator Manchin was among the truth tellers who said, look, if you want to do it or not do it, that's fine. You can have opinions, but you should at least have an honest reckoning of what the cost is. And I think that's where we're at today, picking up on Matt's point. And so putting it all together, when I look at it, this truth teller dogmatist thing, again, it's not about partisans or politics. There are all sorts of people on different sides. It's fixed mindset versus growth mindset. The growth mindset has clearly won, but the future is undetermined. And so what Carolyn, I'm sure, will tell us is how hard it is to manage other people's capital under these kinds of conditions and how open-minded successful investors must be. But one good thing I would say is that with our guests, I just applaud all of them from 2020 through 2021 for being so accurate on their inflation calls, their Bitcoin calls, their emphasis on we love renewables, but be prepared if costs start to rise, and an open-mindedness, as Mike said, to talk about nuclear or any other technology that might come along to upset the apple cart. But that's how I see it, Maynard.
Well, guys, that was about as good of a lead up as we've had. Carolyn, I think everybody's so excited to have you. Like everybody, like we rehearsed, combed our hair, you just really got on our game. Anyway, Carolyn, seriously, we're so glad to have you. Colin, I thought that was a great run. I hope it doesn't mean that 2022 is the year of the dogmatists as they strike back.
Well, let's hope that they're not cyclical either. But I think he does say truth and energy is alive and well. So let's focus on that. Well,
the dogmatists are fun. We need to have some more of them on the show, too. Carolyn, seriously, it's so wonderful to have you. And you see so much. You see so many companies. You think about so many issues. You're in so many debates about where the world is headed. I think maybe just for the benefit of everybody, do you mind just talking a little bit about Texas Teachers, just the scope of it, the number of people you have, and just all the different facets of it? It is obviously a huge institutional investor and very influential.
Sure. First of all, Maynard, thank you for having me. I really, over the years, we've really enjoyed getting to know the TPH folks, and you're one of our go-tos to get knowledgeable about some of these topics. So just to start off, TRS is a little over $200 billion of capital. We represent 1.87 million members, or about 6.5% of the Texas population. So, we're the pension for, obviously, the teachers. The portfolio that I manage, as you allude to, is called Energy, Natural Resources, and Infrastructure, which is 6% of that. We primarily invest in private through general partners and funds. We also do what we call principal investments and some direct investments. Our portfolio can do public and private, though, and we've done some public investments over the years. The portfolio, as I mentioned, we started in 2012. It was official in 2013 with a 3% weight to energy, and it was pretty much specifically to energy at that time. And then 5 years ago, I was asked to take on infrastructure. Infrastructure had been in our real estate group because at that time, all the infrastructure funds were investing in midstream and power. And so, the real estate team was like, this is something we don't know much about. It's technical. So they brought that over. We increased our allocation from 5% and then an extra 1% a couple of years ago. So just following Colin's comments, our portfolio was started as an inflation hedge. Now, it started in 2013 when oil was around $100, gas was around $4. People thought it was going to 125 and 8. And in fact, it did just the opposite. And as you guys know, we've been in this very low inflation environment for a while. So our time has come. And we're really focused on how do we deploy this capital given the backdrop of all the things you guys just talked about. So maybe that's a little bit of background on TRS and the portfolio I'm managing specifically.
So Carolyn, it is a great background, and it shows like there's so many ways in which we can take this conversation because you see so much. I guess one of the things you've seen a lot over the years is the capital flowing into private equity, the various strategies that private equity has had, how those have changed. Sometimes they're organizations with multiple flavors. Sometimes they're just energy, and sometimes they're just a single flavor within energy. What would you say you're observing about just that industry, its interest in private equity, the new players who want to play the transition, and how some of the old players are doing that, some of them aren't? Like, what would you tell us about that community?
Yeah, so that's a really good question. So to the first point, the way we constructed our portfolio is you had some of the general partners, some of these private funds that originally were going and buying land, drilling, and doing what we call the land flip. You had others that were buying production, and they were always more focused on a yield with some upside. You had folks who were doing more of the credit, preferred credit, sort of a gap to the high yield market. And then you had the minerals guys. So you had all flavors, and we put together a portfolio that gave us the risk profile we wanted based on all of those different investment styles. What you've seen over the years is, and what's happening, I think right now, is a lot of the LP capital has pulled away from the market. So the endowments are the most noticeable. I've gotten several calls over even the last month that endowments that have been longtime investors with some of these groups have pulled out, and not that they're necessarily selling what they own, but they're not putting new capital in the space. There's a lot of pressure on these GPs to pivot to more of a energy transition. We'll talk about what that means in a minute, because that means a lot of stuff. And so it has been a pivot. One of the things that we see in the energy transition world is now there's a lot of money piling into that. In 2014, we saw a lot of money from the private world piling into energy and trying to do a Me Too kind of strategy. Some of them didn't obviously work so well. So that we are seeing that. We do think it's going to be more difficult to raise a private fund just in traditional oil and gas. So the folks that we know well are doing some sort of hybrid. And then there's more very specific, very targeted strategies with fewer LPs. So that's where we're seeing some of the pivot in the traditional oil and gas.
So would you say, Carolyn, when you just take a step back, because you've been doing this for a long time, you've seen these cycles, and one of them that you mentioned, of course, is just the capital cycle. And when money is pouring into a flavor and you got to compete with all that money, instinctively that doesn't feel like the best time to get a good return. In Colin's lead-in, these figures about the low amount of money that's going into oil and gas and the low replacement that we have going. The outlook is not for money to be coming back to oil and gas for all these reasons we know. Doesn't it feel like a fantastic time to invest in oil and gas?
Yeah, it does. And that's one of the things we're very focused on right now. The question for us is, and it goes back to, what's your view of what this market looks like, is, to Colin's point, we don't know. So we use a risk framework when we make our investments. And in traditional oil and gas, we just assume we'll be the last owner of record. And so if we're okay holding that for the duration, that's how we think about making investments. But again, we want to make sure we're partnered with the right folks that are also disciplined and being prudent in the allocation of how that capital is spent as well.
Maybe a follow-on question to that. How important is the capital allocation leadership we're seeing in the public markets, whether you're talking about midstream, upstream, service across the board? It feels like over the past 15 years or so, kind of with the kickoff of shale in 2005, that privates and publics are both kind of moving in the same direction. And now we've got a pretty big shift in the way the publics are reacting. How does that kind of influence your views in energy investing more broadly speaking, whether it's a private or public investment?
Well, I think it goes back to what you guys were talking about, that you've got traditionally the public markets, and we know the history with the rig counts. Most of the new production came from the public players. That's been a huge shift because of this discipline. Now, who knows what happens? Again, when we started investing, the energy S&P was like 12% of the market. Now it's a little right around 3%. And so the question will be, will there be more competition again in the public markets? Will they start transitioning? We know what's happening in Europe. Will they start transitioning to using that free cash flow to fund some of the carbon sequestration projects that they have that may not be profitable at this point in time? So it does factor in our thinking because it's obviously competition for capital.
I guess, Carolyn, one question. You, of course, are the T is for, the Texas, T matters a lot in this conversation. How does it affect you? I think we all have this impression that, not to name states, but I guess I will. The California teachers are just going to have a different kind of approach to how they think about energy. You could start New York teachers, et cetera. You could start going through all these states, and and it seems the investment philosophy definitely starts to reflect the state. We're all Texans. It's at least adopted Texans, et cetera. But Texas feels like free enterprise. We do renewables as big as anybody. We obviously love oil and gas. We tend to not like regulatory. We're free markets types. I guess I'm just asking, is it great to be investing on behalf of Texas? Does it give you more freedom than any other state, or am I getting carried away in my love of the great state of Texas?
Yeah, well, of course we love the state of Texas. Absolutely, as it comes to energy, no doubt about it. The other states that you mentioned, California and New York, have been very vocal about their ESG mandates, and that has been a big part of how they invest. I come back to, we're trying to make the best risk-adjusted returns. So we don't have an ESG mandate. Some of these big states and the Europeans have been vocal about making no new investments in energy. Some are divesting of energy. But that's not the case for us. So that gives us a lot of flexibility as we transition, as the energy markets begin to transition, both in terms of supply and demand of capital and just supply and demand of the commodity. It also helps that everybody you talk to in Texas knows something about the energy markets. Most people know the rig counts in their county, so that's pretty unique as well.
Can I just ask one thing? Because I think Matt's got a good technical or technology question for us. But there was some discussion over the last couple of years. I think it was in the previous administration about, how appropriate it was to have some of these considerations around investment, how those conflicted with the fiduciary obligation to make the most money for your holders. And that's sort of a fascinating sort of battle to me, because nothing seems to be more sacred, if you will, than take a dollar and invest it wisely versus take a dollar and invest it in things that can sometimes be amorphous and subjective. I know I'm like going right into a big mess here, Carolyn, but what are we going to make sense of that? Is this going to get better, or do people realize, or what do you think? How does this play out?
Yeah, that is getting into a mess. That is a really complicated question. Obviously I can't speak for my colleagues, and I know, these folks really well because they're, LPs with us in a lot of our funds. I do think there has been some sophistication. We're starting to see some sophistication, because when you push people now, they're like, no, we're not divesting. And I think just looking at what's happening in Europe, people are, starting to make some realizations. But, I can only speak for TRS, and what our, first and foremost is to make this return for our teachers. And we have to generate a 7.25% return every year. So we have an actuarial rate we have to hit. And so that drives a lot of our decision making. Now, what's complicated it slightly is, because we have other opportunity sets to invest in. We keep coming back to what's the risk, and is the risk justifying the returns? And that is a big part of our decision making as well.
I know one of the biggest moves that we've seen over the last 12, 18 months has been this move for companies on the ESG front. And going to the question of your return of 7.25%, it seems like ESG has taken over returns. We got to be in really great companies, whether the returns there or not. How does that factor into the way you guys manage money, and what are the pitfalls of that?
So, go back to, we don't have an ESG mandate. However, our portfolio has always, let me take a huge step back. There's the E and the S and the G. And I think one of the factors is this has all gotten muddled together, and they're pretty distinct. So to just talk about the E, because that's mostly what we focus on, we have always incorporated E as, when we look at risk, right? Is this company, or do they have any violations? Are there headwinds? What's the risk going to be around the E part? But again, we don't have a mandate one way or the other. And to, full disclosure, we've been making investments in renewables for a decade, because they were good investments in the jurisdictions where we were making them. So I do think the ESG conversation, I do think people are starting to recognize that it's kind of three different conversations all going on together. I also think as people start getting more focused on reporting, because that's another one, the reporting now, there's just so many different ways you can report this. So when you look at it, it's just confused. I just get confused. But as people start honing in on and think about scope 1, 2, and 3, you'll find out that you get into scope 2 and it gets a lot more complicated. Energy was easy to focus on because it's an obvious scope 1, but you start getting into scope 2 and you think about all the, delivery vehicles and other things that might be driving other industries. And I think that the conversation will get a little more focused fairly quickly.
Sometimes when, ESG, if you say at some level, ESG really represents, does the company have a good culture? Are they good stewards of the environment? Are they good members of the community? Do they make decisions by listening to diverse opinions? Do they have, proper controls? It's kind of a cultural question before you get into scores and rankings and things like this. When you're just trying to make a gut assessment of, does a company have a good culture? Like, does it seem to have good bones? Or a fund, does it seem to have good bones? Are there just a couple of tricks of the trade that you've learned that when you look at those companies, you just try to, usually you tend to see this or you tend to see that, or, it could be the CEO's compensation. It could be it could be anything, but I just assume a veteran like yourself probably has a few key things you look for to know if it's an underlying high quality culture.
Yeah, so that's also a really good question. A lot of it is just, people have reputations, right? And firms have reputations. And as you just talk to people and get to know folks in the market, that will bubble up. And you talk to who do they do business with? How are they in doing business? So when we invest with a GP, TRS has what we call a premier list, and it takes a while to get on that. We narrow down who are going to be our partners because we're very relationship focused, and we want to make sure people understand, what we're trying to accomplish. And we do have a lot of metrics we look at, but it's making sure people are good at what they say they're going to do, deliver on what they say they're going to do, and stick with what they told you. So those for us are really key in telling. That doesn't always happen.
That sounded like a Texas, that's old school ESG. They tell you the truth, right. They do it, they follow through.
Yeah. But, GPs will have strategies. And then, 6 months into it, they're doing something else. You're like, well, wait, you told us you were going to be doing this, and now all of a sudden you're this. And, it always comes full circle, though. We know that.
Yeah, that's why I emphasize the truth telling. And it's really important to emphasize you're allowed to be wrong. You're just trying to be honest. And I think you make a great point where we see a lot of people make the false assumption that if you're for hydrocarbons, you're somehow against solar or wind or nuclear, which is just absurd. That is just not true. And so one thing we've constantly tried to emphasize is to be for something is, to be for the truth and to emphasize it. So, with that in mind, I guess, as you're looking out over, the next year or two, what are some of the things you're worried about? What are some of the things that you're thinking about that you wish you had more information on that we or, other truth tellers could provide to you information wise?
Yeah. So, inflation is obviously one that we're worried about, because you see costs going up, and will our returns be able to keep up? I think in terms of the energy market specifically, I'm going to go back to this energy transition thing, because it started with, we're going to bring you a wind farm or a solar deal. So that's what that meant a decade ago. And then, as you guys know, it's morphed, and when people come and say we have energy transition, we start with, well, how do you define that? Where exactly are you investing in this space? So it's now carbon capture and sequestration. Even that, are you on the capture end or the sequestration end? Hydrogen is another one that I know little about. We're still getting, up to speed on. Nuclear, we haven't spent hardly any time on, to be honest. So it's just, what is that mix going to look like? And the other thing is, this is largely was started as, this is a transportation discussion, but we know with this electrification of everything, it's now become a power discussion. This was my crypto comes in. We have seen a lot of data centers being built, and as a community, we're all just become data hogs. So, and that's basically a guaranteed power source. The rent is quoted in kilowatts. So we've seen in some of our power investments, particularly around crypto, they want a guaranteed power source so they can do this for the next 3 years. And these are in merchant markets. So you start just thinking about how are we going to live? I think COVID really changed that pretty quickly. I'll be honest, I didn't really love Teams before COVID, and then had to learn it pretty fast. So I think that transition has happened quickly. That's where we're focused on, what is this mix going to look like? Where are going to be the best risk-adjusted returns for us in the traditional oil and gas? Same thing with the energy transition. Is it going to be in the carbon capture? As you guys know, we've seen and made some investments in transporting carbon, particularly around ethanol production, which is, where some of that's happening. So that's the stuff that's exciting. That's actually really exciting. And the two, I think you guys hit on it, the new technologies that are going to come out of that, because this industry is just so smart. I mean, there's so many really smart engineers that know how to manage this, what I'm going to call an evolution. So that's the stuff that we're focused on. You know, what concerns us is obviously where do energy prices go? When we look at energy investments, we want to make sure we're downside protected. You know, we're focused on getting a yield, inflation protection, and then obviously because we do a lot of private investing, we need that illiquidity premium. So that was a long-winded answer about what we're most concerned about.
Maybe a couple of quick ones to unpack there. I guess just as new asset classes do emerge, like crypto mining in particular, how important is it to understand that business model? We're seeing opportunities around flared gas. We're seeing opportunities around reclamated coal. We're seeing traditional PPA offtake contracts on traditional coal plants. We're seeing, opportunities around underutilized wind and solar. How does that fit in terms of just your broader view of use of energy, kind of creating a new asset class and an investment opportunity for someone like yourself?
Yeah, so my holiday reading is crypto, to get smart about this space, because to your point, Matt, we've seen some of these, like we need a dedicated source power in some places in which you don't think of, large power markets. And so crypto is one, but I think it's broader than that. But it's definitely, when we invest, we look at themes. Is there a theme that we're thinking about? And that's clearly one of them that we got to make sure we understand the implications to us. I think the other one that's a little interesting is, for the first time we saw in a long time, we saw an investment with a minimum volume commitment, and it was to a power company. Part of it was the ERCOT issue. We can't get caught short again. So we got to make sure we got good partners and we're going to have delivery. And part of it is their end users that are asking for that same thing. So,
Carolyn, while we're on the technology theme, I guess one of the things that we're always interested to understand is how investors assess various technology risks. Sometimes the technology is unproven. Sometimes it hasn't been scaled. Sometimes you're kind of wondering, it's the management team and can they properly execute? And then sometimes you're just worried about acceptance. How do you guys think about assessing technology risk when you see it?
Yeah, so, I mentioned at the very beginning that we have this risk framework, and that is one of many of the risks we look at. But the other thing we look at, technology, is also disruption risk. So, when we think about new technologies, it's like, where in that evolution do we want to invest? And if it's too early on, then the risk profile is just too high. It gets a much higher rating in terms of, is it a technology that's proven? Because you don't have guaranteed revenues like you would with a proven technology. But the flip side is, and what may happen that disrupts or changes the use of this technology going forward. So we look at it both ways.
Maybe as we wrap up, Carolyn, you've been so generous with your time. I think one of the things we're all wondering about in energy, whether we're producers or tech companies or finance companies, it's the competition for talent and young people and just people who want to really dig in and be a part of all this. And obviously, the more traditional you are in energy, the harder it's been to get those people sometimes. How do you think about young people and drawing them into the energy challenges and opportunities of the next 20 years so that we can really do all the good we want to do?
Yeah. So on the energy side, I think it's a couple of different facets. Obviously, we look at folks who want to invest in the energy space, but my portfolio, we have people who come from industry. We have people who have been engineers and went and got an MBA, people who've been at GPs and LPs. So I think going back to, this is the time when you show real leadership and can really make great investments are during periods of disruption and change. And to me, that's what's super exciting, because you think about the traditional oil and gas is going to be around certainly for the rest of my lifetime. And so maybe while it's not as exciting, we are now in a very different time period than we were when obviously this portfolio started. So from an investor perspective, we try to talk to them about, we're trying to create a portfolio, and that's both challenging, and that's the exciting part. And we're also learning new things. And the last thing from an investor standpoint, energy is super interesting to invest in. I go back right to where we started. Depending on what risk you want, there's different places in the barrel, so to speak, you can invest. And that also makes it interesting from an investment perspective.
Well, now you jumped on the last theme I was going to throw your way, Carolyn, which is you have seen energy for a long time and you've got a fantastic vantage point on it. I don't want to lead the witness, but doesn't the next 10 years look like one of the most fascinating periods to come that we've seen in quite a long time?
I've been doing specifically energy for 10 years, so it's definitely the most interesting in the last 10 years. But I do think, the industry is much healthier than it was a decade ago. I do think some of the capital that was spent helped advance some of the technologies that a decade ago weren't seen as, or were questionable how valuable they were. So I do think it's an very interesting time. And, at TRS, we obviously, because we have a portfolio dedicated to it, think it's a good place for us to make prudent investments for our teachers. And that's the most important part.
I said earlier, Carolyn, I said, T is for Texas, but only that second T. The real T with you guys is for teachers, and you're taking care of our teachers. So that's pretty darn important. So thank you for all the hard work you guys are doing.
Yeah, absolutely.
All right. Well, I'm gonna close with a couple of things. We've got the holidays coming, so I found this in my house today, and I was able to change the battery. So I hope everybody has a wonderful Christmas season and New Year's. And it's also another holiday today. It's my friend Chad Michael's birthday. I don't know how old he is, but he's pretty successful, pretty young. He's ready for these next 10 years. So, Carolyn, we really, really appreciate you coming on and wish you all the best, and can't wait to talk to you in 2022.
Thank you so much. Sorry for the technical difficulties, but I really enjoyed all the questions you guys threw at me, and have a wonderful holiday.
Great. Thanks, everybody. Merry Christmas.